are you?
Good. How are you?
I'm good.
Welcome, welcome. How's business going, Bob?
Gangbusters.
Oh, yes. Love that.
Yeah, it's a little scary. We've doubled our staff in the last probably 4 months. Had to get more space, all kinds of fun stuff like that.
Oh, good.
Wow, congratulations. Scary but
Thank you.
good.
Yeah.
That's good, good, good. Well, we had a smidge of a technical difficulty, so let's give everybody another couple minutes because we have several folks who said they were coming that aren't here.
Way on their way.
It's Friday. Anything exciting going on this weekend for anybody?
Wedding, yay.
Oh, wedding. Family wedding, or I don't have to worry, just show up and have fun wedding?
Show up and have fun. My kids' friends are starting to get married, so
Fun.
yep. Everybody's growing up. Except
Yes.
me.
Except you. That would be something my brother would say.
What is it?
And
Ain't nobody got time for that.
that's right. And Travis and Skylar are here.
Hello.
Hey, Skylar, how are you?
Good. Happy Friday.
It is Friday.
Happy Friday.
All right. Do we have anybody else in the waiting room, Laura?
No, not right now.
Okay. Well, I hope we had 3 people get in, so the technical difficulties were not for everybody, just for me. So we're good. All right. Well, let's get started. I am going to share. Oh, Mark went away. There, now he's back. Okay, you guys can see my screen. We have going on here.
Looks good.
All right. Well, we're happy to have everybody this morning. So welcome to the Vision Path Vault. And today we have a special guest presenter with us, Mark Newley from Saybrook CFO. And I will shout out to Mark. He was the mentor that I have had since my very first day as a fractional CFO. So for good or for bad, we blame him for where we are. Yeah. Welcome to my world. Thank you, Mark, for helping us be better.
Absolutely.
Yeah. So I think everybody knows me, but I'm Hillary, founder of Vision Path. We're strategic business advisors from the CFO chair. And one of the passions, and I have personally in the mission of Vision Path, is to educate others. We all have a thing that we're good at, and this is what I'm good at. So let's share and help people be better in their businesses. And Mark is along that same path of education and helping out. So Mark, you want to talk a little bit about yourself?
Sure. So yes, Mark Newley, founder of Saybrook CFO. 15 plus years in the industry of outsourced CFO work. Hillary and I worked together under a national firm and then spun off onto our individual firms. We do collaborate a lot. But yes, we're focused on helping privately held business owners in that really $2 to $50 million revenue range. We maximize cash flow, drive growth, and improve performance for individual owners.
Love it. Okay, so today we are going to talk about margin killers.
So yes, here's a dozen margin killers. There's lots more, but I'll call out a few of them. For instance, poor revenue mix. A lot of times, businesses have different product lines that are producing different margins, and based on the mix, that could affect your overall margin. Things like discounting creep. That happens because a lot of times businesses will want to discount in order to get the sale, in order to get the growth, but it actually is negative to the margin. Unbilled work. This happens a lot with project firms where they put out a project estimate that maybe it's going to take 10 hours and it ends up taking 15. They can't recoup on the cost of that, so that will affect the margin. And of course, the last one I'll pick out is vendor cost creep, which is in this economy, we're seeing every vendor raise their price no matter what. Between tariffs and fuel and everything else, if we're not adjusting our pricing to go with that, we're going to have a negative effect on margin.
Yeah. So if we talk about what is margin, not all margins tell the same story. And margin is the definition of actual, like the word margin is just the percentage of something out of a total, right? So generally, we talk about in the world of finance and accounting, generally the two that everybody knows are the top two: gross margin and net margin. So gross is revenue minus cost of goods sold or cost of sales, which is the things that you spend money on to actually produce the sale. So people, software, materials, if you're a manufacturer, and it's, if I sell something, if I don't sell anything, I don't have those costs. Those are cost of goods sold numbers that we want to have in there. When we look at net margin, that's the bottom line, all the way at the end of the income statement or the P&L, and whether we're actually making money not only after we produce the sale, but also after we pay for all the overhead and the owners and the people and the things that it takes to actually run a business. The other two are ones that people may think about, but not know that there's an actual accounting term. Contribution margin is where you break up the margin by a thing, whether that's a product, a service, a client, a specific job that you're looking at. And what you're looking at when you do a contribution margin is the margin that thing, the product, service, client, contributes to the overall value of the company. And we want to know, are these specific items profitable? So you look at your top 5 to 10 clients, you look at the jobs that you're doing, you look at the services that you're providing, and you want to know, are you losing money on any particular one, or is there any particular one of those that's really just phenomenal, and that's where you want to lean in. The last one is cash margin, which is the one that people probably think of a lot as well, which is after I get done with everything, I pay all my bills, I pay all my loans, I pay myself, I do everything I need to do. Do I have any cash left in the bank? Because although revenue is vanity, profit is sanity, cash is queen. So that is the thing that's going to drive, at the end of the day, an overall ability to continue the company, to grow, to add value for eventual transition if you want. And so we really want to look at cash margin as the last measure of, yes, we're doing well, or no, we're not.
So
Mark.
This chart, revenue is up. So this is a common situation for a lot of business owners where they see revenues increasing. They think their business is in great shape, but this could be also warning signs for another problem, which is margin erosion or slipping. So on this chart, talk about sort of the warning signs there in the first section there. So revenue is growing, but margins are not. Cash flow starts to fluctuate. The team is busy, but we're missing some efficiency, and again, more clients, more work, but we don't have the financial clarity or control to understand what's going on. So, but behind the scenes, what's actually happening is, yeah, the pricing isn't keeping pace with the growth or complexity. Uh, so, that's something where you have to take a look at the pricing and make sure that it is going well, and understanding your costs and how they move. Um, Discounting is one of those items that, while it's in a lot of industries is necessary, it can get out of control very easily. Um, and then costs continue to creep into delivery, labor, vendors, all of the above, and then low margins start to be accepted based on just keeping the growth going. So growth is not always going to get you the profit that you want.
Which leads us into the number one margin killer. So, Bob, you said you're growing exponentially, which is awesome. We love that. It actually, if you're not careful, growth can hurt the bottom line, cash, overall value of the company. So this isn't, I forgot to tell everybody at the beginning, this is an interactive conversation, not a lecture. So, Bob, specifically, if something is resonating here that you want to talk about in your growth mode, absolutely, let's do that. But when we look at growth, if we are scaling without pricing adjustments, if we're taking on lower margin work, misaligned sales incentives, if we are growing with additional cost, because we have to keep adding people because we're not efficient. There's a ton of different things that you can look at in that growth. You said, Bob, I think you said you had to get new space, right? So if I get to a point where space is a great example, people are another one where it's a stair step, right? I have 7 people, I have 2 offices, whatever it is, and I can handle, and then all of a sudden I can handle all the work I have. And then I have to spend money and get another person or another space or another machine or something. And then I have all this capacity. So for a little bit, I'm going to be overstaffed. I'm going to be over budget on the equipment that I have. And then I'm going to run my capacity up. And then I'm going to be super tight. And oh my gosh, I'm doing so much and busting at the seams. And then I'm going to have to buy another one. And then the same way. So one of the things that in this example that we have on the screen is that, marketing company is taking on a lot of work. They started saying yes to more client work. They're doing different types of client work, which is the strategy and the revisions to someone else's work. And in order to do higher level, they have senior team involvement, more so in their standard packages. So this company was a bit of a change, right? They morphed into something that they hadn't really done before, took on a little bit bigger projects, a little bit more in depth. Everybody's working beyond capacity. So Bob, you got new space. We had to hire new people, all of those things that feed into how do I take care of additional work that is coming my way. If I don't hire, if I don't take on more space, if I don't take on more equipment, you can run into, wow, I'm serving clients, I'm serving more clients, but I'm not serving them as well. Quality can drop, turnaround times can drop. I'm having to do a lot of rework, which means now I have a delivery problem. So we love sales, but if we have sales without good delivery, we don't have cash, we don't have incoming money. The other thing a lot of times that people do is they don't keep pricing up. As Mark said earlier, everybody's prices are going up, inflation, costs. If you haven't had a price increase recently, then it's probably something to look at. One of the things that I learned early on was, it's easier to raise prices on new clients than it is to change prices of old clients. So if you have a group of clients that are at $250, and I'm going to raise them to $300, and then I'm going to raise not them, but the next set of clients to $300 or $350. The other thing to look at is the deal size. Again, as you grow, where are you growing? How are you growing? Who are you growing with? And are those deal sizes bigger revenue, but less margin? That's a problem. So when we look at all of the things that we're doing, we can see the indicators of where you can see those issues are. Gross margin is now declining. Your contribution margin is going down on the bigger things, the new projects. And it may actually be going down on the old stuff that you were doing because you're spending so much time on the new. Everybody's working longer hours and gets really cranky, and Starbucks coffee is not going to cut it for them anymore. And cash flow feels tight because we did have to hire a new person, get a new building, develop new products, any of those things that we're putting on the requirements of cash in order to grow. And planning from that is going to, for that cash spend is a whole nother conversation, but you want to make sure that you're looking at that spend and you're planning for that in the future so that the growth, not only you're not killing your margins, you're also not killing your cash. And one of the ways to fix that is pricing.
So, yes, second margin killer that we're going to talk about is pricing drift. And again, you see what some of the symptoms have to do with temporary discounts becoming permanent, or you just haven't changed your pricing, or you're just not communicating your value. So I kind of would do this in reverse and say, okay, first of all, are you communicating the value of what you're selling or providing, to be sure that people understand the value? Then, as Hillary mentioned, legacy pricing, make sure your pricing is right based on market, based on value, based on what you're delivering, and then keep yourself from having to discount in order to get the job. That's really, those are the things to keep in mind or look at from a symptom standpoint. The example here on this sheet is a construction company where they've actually done a great job of watching their costs and adjusting for materials as jobs go up. But what they've been missing is sort of the labor piece, and they haven't adjusted that enough or quickly enough. And so they're starting to get more complex jobs or overruns or delays that are just running up the project. They gave an estimate at that and can't change that, so therefore they end up with a hit to margin as a result. So then in the blue square is kind of what the financials reveal based on just not having labor dialed in correctly. So again, material costs are covered, but we're missing it on the labor, and gross margin begins to tighten. So this also creates that cultural piece that Hillary also mentioned there, where everyone's busy, but it's just not feeling profitable.
So the last one, in the example from a cost perspective or from a margin killer perspective, cost. A lot of times we see cost in an invoice that comes in, right? It's very easy to see that the plants in our example here from this nursery, which by the way, I've been in that nursery, although that is a stock picture, right? Every nursery you've ever been in probably looks just like that. So, plants went up. How do I know? I got an invoice that says plants used to be $5. Now they're $7. Okay. But there are a lot of hidden costs that you can see, which actually also contribute to margin erosion. Labor inefficiencies. If you have 2 or 3 vendors that are doing what one vendor used to do, you now have more people to take care of, more checks to send out, more processing to do with folks. And then the big one that people really can get a lot of traction in is looking at processes. So nurseries expanding, they've had big demand, and they're creating more space to sell more plants. The problem is for these guys, they've been moving plants a ton. And they're literally paying someone to move plant from spot A to spot B, from spot B to spot C. We're going to rearrange, we're going to undo, redo the displays and the setups. And so every one of those has got a labor component cost attached to it. And when we look at the process of not only am I moving things around, but how am I doing my actual setup in the first place? How am I running the process from a consistency perspective across all of the employees? So if every employee is doing things slightly different, and from not only a production standpoint, but an ongoing maintenance, a communication, documentation. We do not want everybody to be a robot and do exactly the same, right? Because our clients are not all exactly the same. But we do want to make sure that we're efficient in what we're doing and how we're doing it. If you think of McDonald's, right? You get a McDonald's hamburger, no matter where you go, it looks and tastes exactly the same. They are a killer on process. You will do it the way they tell you to do it, period, end of story. So depending on your clients, that works great. Maybe not for everybody. And so when you are looking at the process of providing your service, can you create a process that is consistent so that when Joe and Sam and whoever are doing all of these things, they are actually doing them not at an additional cost in that process. The other thing to think of in process is the steps. So we used to say the number of steps to a printer. Do I want to buy another printer? Right? Think of a big office with lots of cubicles. I have one printer. That means everybody has to go to the end of the room. Some people are walking 2 steps. Some people are walking, 1,700 feet. And then they all converge around the printer and we take 5 minutes to pick up a piece of paper, go buy another printer. Not that I don't want people to talk to one another, but I'm cutting down on the amount of time people have to walk across a room to get to a printer. The same thing for, in this particular case, if we're looking at inventory, is the same type of process, right? How much inventory do I need to have? Inventory is cash sitting on the floor, on a table. And you want to look at, if we're ordering the same plants over and over again, but we're not looking at sales. Okay, I'm buying a bunch of pink flowers. Nobody's buying pink flowers. I'm wasting. I'm buying things that I run out of. I run the sale, that our local nursery has a wacky Wednesday. They have sales on Wednesdays. And they ran out of stuff by 10 o'clock in the morning and everybody's disgruntled. Sales don't work anymore. Seasonal staff are brought in, especially for things in construction. If you think of the summer type businesses, nurseries, but we don't have enough training. We don't have consistent documentation on processes, what we do. All of this is going to lead to increased labor cost, dead or unsellable products. If we have things that are dying, literally dying on the vine in this example, input costs are higher if we have multiple vendors and if we are not paying attention. The biggest one that people have had historically is utilities and telecom. So all of a sudden, if you start looking at your telecom bill, whether it's AT&T or landline or Verizon, and it doesn't matter who it is, internet, there's a $5 fee for this and a $7 fee for that. And pretty soon you're paying $100 more a month than you ever thought you were. You just didn't notice it because it was $5 at a time. So really looking at all of those costs, breaking them down: input costs, process costs, people costs. How are they each contributing to the margin is how you're going to be able to shrink that killer of the margin from that perspective. I want to stop there. Does anybody have any questions on those that we've talked about? Bob, from your growth perspective, are you seeing some of these?
Yeah, I'm seeing every single one of them, right? I mean, I'm going through the process right now of recalculating what our cost of services are, because we know we need to update our pricing, and I want to make sure I include all of the new costs that I'm having to bear so that I only have to do this once not have to turn around and do it again in 6 months. So with my growth, that brings a layer of management cost and overhead that I haven't had to have before, right? So I've got to include all that. I opened a second location. My overhead there is significantly lower than my first one. Same thing with my labor cost. So I've got some things that are driving my cost up and some that are driving them down. I just got to make sure I see the whole picture to know how to adjust my pricing.
When
And
you're
then we're also
looking,
seeing some of the hidden costs as well, that with the fast growth, the new hiring, not everybody's up to speed. They're making mistakes. They're having to do the work twice, so then the cost goes up. So yeah, we're seeing all of that. We're aware of it, and we're trying to account for it.
excellent segue into how do we try and fix them?
Yes.
Yay. Perfect
Right.
timing.
Yeah.
So what do we do about it, right? And then how do we fix the leak? So um, there's come up with 3 steps really. Just sort of first step is kind of diagnose or figure out where to look to find the leaks. Um, and then a couple of ideas here. Go beyond your P&L. Look beyond just the revenue, but look at by product, by category, by service, whatever it is. Um, Start to compare. Uh, you know, Make sure if you don't do estimates or budgets, at least compare to last year to be sure what your trends are doing, what's happening there. Um, Track the labor. The labor is the biggest piece. It's your biggest expense. It's your biggest asset, and it's also the one that can be the most efficient. So that's always important to take a look. Um, Touch points. Are things getting reworked, or is there waste or scrap, or um, again process improvements that could actually help with touching things less and moving it faster. And then always look at your top 10 customers or your top whatever list of customers you got, because those are the drivers of the business. And if we get those right, the rest of the business will follow. So again, it's kind of like digging into looking beyond just a P&L statement. And then second step is really decide what you want to do about it. So we can either process improvement, we can either uh, just focus on the higher margin stuff and stop the stuff that's not getting us the margin we want. Uh, and so that's why we have optimize, reallocate, or eliminate. Um, and so once you decide, then we have to execute. And execute requires make somebody accountable for it first and foremost. You know, Create the matrix or the KPIs that are going to drive it, and then review it constantly. And be able to adjust. Look at it often and then adjust. So this is not a once a year type of thing. This is a ongoing, monthly, quarterly type of approach.
Uh, um, so in our standard, hey, we're going to give something away. We have a calculator. So you can scan on this, and Laura will put in the chat, and we'll make sure that we get a follow-up email to everybody with the link to the slide deck and the calculator, so that you can download it. Don't leave your information in the calculator on our folder, because anybody else would have access to it unless you don't care, and somebody may have a great idea. But when we look at margins and what we fix, as with anything in our business, nothing is in a vacuum. Everything is part of the system of the company. One person depends on another. We depend on the technology and the process and everything to work. And sometimes it's us as owners and leaders to stand up and go, yeah, I showed up to work today. I'm not in a crappy mood, I promise. What we want to make sure that we're looking at from a margin perspective is the 4 types of margins. So if we go back to the gross margin, tells us if our work is priced appropriately, if the cost specific to delivering the actual product in total is working. So Bob, to your point about I had lower overhead costs on one location versus the other. So you may in a vacuum look at one location and go, oh my gosh, I don't want that one because it cost me more. But when I combine the two, I am getting a relatively decent average overhead cost between the two, but I'm driving more revenue because this first location was the flagship and I put a bunch of work into it and it's bigger and I can have more products and more people come through, and versus the smaller one. Now, sometimes I have a client who has two locations, actually a big and a small, and they created the small one as a satellite location to the big one, because the big one was always full. What they figured out now about 5 years later is that the overhead to run two is not worth the juice, isn't worth the squeeze anymore. So they're looking at how do we get one little bit larger than the first, not as large as two of them added together, kind of in the middle. But there's cost to that as well. When we look at the contribution margin, product first, client, product or service, client, and then the cost of producing. So Bob, your two locations, or if you are trying to get into a different, I know Travis is from a CPA firm. They do accounting, they do tax, they do audit, they do consulting, they do a lot of different things. Well, maybe you're really good at audit and you are not very good at tax, which would be Hillary. I don't want to do tax, think you know. And so, if you're in that world, then what does that look like? And if I'm not good at it, stop doing it or change how I do it, so I know what's going on in that world. I am going to, okay, hold on a second. Let me stop sharing. And then let me share where's my margin killer? Hold on.
I was going to say the sheet is in the chat if you need to click on the link. That's
there. Now I got it. Okay. Can you guys see my screen now? The margin killers. So this is a contribution margin calculator. So a lot of the margin contributions that we do in QuickBooks, for instance, you can get a % of revenue. It's already in there. Contribution margin is something that you just need to think about a little bit differently. So there's 3 workbooks, 3 work pages, worksheets on this, man, it's Friday, workbook. Instruction sheet just walks you through. I'm going to go in here and type some things. So we have Hillary's Hippo holiday hangout. And we're going to do 2027, or I'm sorry, 2026. God, it's me. It's today. So I have a Hippo hangout. My product, I have, you can do Hippo playtime. And we have, you can do the Hippo hotel. Literally making this up on the fly, just so you all know. We're going to do 2 products. So if I go through and look at what does it cost to do Hippo playtime, just go play with the hippos, right? Hang out in the pool with the hippos. What is my revenue just from that? So I am going to say that, my product sales is $50,000. I don't have any labor from that. From the Hippo hotel, which is where somebody can actually come and stay with me, it's $120,000. I'm making up these numbers as we go. So there's my total revenue. You can put as many products in here as you want. This is set up for 5. We then want to go and look at the variable costs. So if I am Hippo playtime, fixed costs are the actual enclosure, right? It's there. I have to feed the hippos whether somebody shows up or not. The variable costs are I have staff to monitor the playing of the hippos. if there's nobody in there playing with the hippos, I don't have to have a staff member in there monitoring that, right? So if we go look at direct labor, let's just go with me here. We're going to say that it's $15,000 for that. And I paid somebody, $5,000 for the commission. It cost me 3% for my credit card fees. From a variable cost perspective, I have a hotel, whether we have 1 or 200 people, right? I still have to have the same amount of staff. And we've had a lot of problems this year with bookings. People come to play with the hippos, but they don't really want to stay overnight. Haven't had any sales commissions. We've had credit cards, whatever else we have. For the hippo enclosure, right, rent or lease, I'm filling in things. We have overhead expenses. Anything else you want to put in here from a fixed cost perspective? And then we go to the actual dashboard. So what this says is my revenue was 50 and all of the costs that I put in, the variable cost, I have a contribution margin in dollars of 28. That's my cost. I'm sorry, my revenue minus my cost. So that percentage is 57%. So what that says is that for 57% of the sales dollar that I bring in goes to overhead. It contributes to the margin of the company to be able to cover overhead. So if I have fixed costs of $9,400, which is less than 57%, then I have an operating profit. My break even is 16,000. I'm actually making 19,000. So, and then this gives you your margin of safety of what you need to have to cover everything. If I go to the Hippo Hotel, now we're all pretty smart people. We can see that costs are more than revenue, right? So that's a problem. What this shows you is if you had multiple products in here, and I did not make them as obvious, you could go in and say, oh, well, this one is contributing a lot. This one is contributing a little. This one is contributing not quite as much. So if I go in here and change this to 75,000, you can see now that we have, the Hippo playtime is 57%. The Hippo Hotel is 34%. Maybe I don't want to continue the hotel. If it was a loss or it was only 5% of my margin, don't run a hotel. Go run the Hippo playtime, expand that, in the capacity that you can handle hippos and people and all of the parking and stuff like that. Just don't run a hotel. But that's a stupid, simple example on how you can put in the different products that you have, service lines, anything. You can put people, right? I have one salesperson who is bringing in 50,000 in revenue and costs me $28,000. Great. Every dollar he sells, I'm making 57%. Somebody's bringing in 120. And if this were, 80,000, then that would be a lot smaller. I don't want to keep that salesperson. And there isn't anything that you can just say, flat, I looked at this number and 34% is not high enough. They have to go away. It has to be in conjunction with the whole of the company. So Bob, to your point about my first building has a higher overhead than my second building. Maybe you don't want to move from your first building. Maybe you add a third building that continues to bring them all down. So there are other contributing factors. But what you want to just make sure is that you're looking at things. It's just another way to slice and dice the information to see, am I contributing to the overhead and the bottom line and the cash and the value of the company based on each of these things that we do, the people that we have, the clients that we have, anything that is a breakout from that you can do in your company to look at. So.
Yeah, I think this all makes sense. The maybe slight difference my perspective would put on it is, as a fast growing startup, profit isn't my number one goal right now.
Right.
And
Value.
I may be okay taking a job that's, say, barely breaking even, but it covers a ton of overhead.
Yes.
So I may make decisions a little bit different and keep some of those products with a very low margin.
Mm-hmm.
But that's a strategic decision, not a financial one.
Yes. And that's the not in a vacuum.
Yeah.
Absolutely. Absolutely. So. Okay.
But at least here's a model that you can easily calculate it and feel comfortable with.
It definitely provides inputs into the decision-making process.
Mm-hmm.
At least we know, right? That's the first place to start.
Absolutely. Okay. Are you guys seeing the screen?
The thank you screen?
Yep.
Yep.
Okay. So that is the calculator.
Mm-hmm.
Okay. Now back to our margin killers.
Right. So, and I think, again, today we only looked at 3 margin killers, but here's a dozen. There's probably many more that we could think of. But I also think that there's many companies that need help in analyzing and figuring this out, because I think a lot of business owners, they either don't have the depth in their accounting department, but this is the kind of thing that Hillary and I do for firms to help them understand the different aspects affecting margin and how to go deeper and really analyze and understand it. So that's why we're here today.
Yep. Okay, we have come to the end of us talking, and if there's any questions whatsoever, we thank you guys all for coming. Mark's contact information, my contact information is on there. Is there anything else, Bob, that you thought of? Travis, Skylar, any questions that you guys might have or would be helpful to discuss? We're happy to do that. We'll make sure that you get all of the information. And then if you want to join us for our next one, we are going to have a class titled Don't Hate the B Word. And that would be budgets. Budgets. You can throw forecasts and projections in there as well, but budgets will be the big one that we talk about. So.
Well, I love it. Thank you. The timing on this is perfect. Those 12 margin killers are absolutely things that I can potentially even add in as line items as I review my cost of service model. Make sure I'm thinking of all 12 of those. So yeah, the timing's perfect for me. So thank you.
You're welcome. Glad you could come.
Yeah.
Hey, Hillary, I have a question. And Mark, in your experiences, have you guys ever interacted with like cost reduction consultants? Is that something you've navigated? Is there any value in that? Or like, what are your thoughts on that?
Yeah, you're talking about like the ones who come in and review your telecom or your waste management.
Yeah.
Yeah. Schoolie Mitchell is the one who comes to mind.
That's what I think of too.
Yeah. So I think they have, depending on the size of your company, my experience has been they have a value depending on what they're looking at. and how much effort it takes to get. So, Bob, have you heard of those? You know, when he's talking about they're companies that come in and they have a
Yeah.
process set up to look at all of your, you know, telecom or utility bills or whatever. I think if you don't have the resources, Travis, internally to go and have those arguments and conversations, I know they do freight and utilities, they do a lot of different ones, then I think it can be worth looking at the value of what they can bring you versus the cost. It's kind of an opportunity. It's kind of a hidden cost in that they saved you all the money and then you have to write them a check. So it's not like they're going to send you cash that you can then turn around and give them a percentage of. It's well, I didn't send out 100, but I only have to send out 20. So a long time ago, I did it in several of the companies that I worked for, and we did it for telecom. It was a huge thing for us because there was so complicated. We were I was in hospitals, and you have, you know, pay every room has a phone in a 700 bed hospital plus 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 plus. I think the smaller business, I haven't seen it be as well worth the value.
I think it works well for certain types of expenses that are complicated, like telecom. But you know, it's also not a holistic approach. So you know, they come in, they work on that piece, which is helpful. But there is, you know, they obviously want to get paid for the savings that they create.
Well, and I'm going to say from my experience, they provide a perspective, not, to your point, a holistic view. It's just a decision point. It's not the decision point.
Mm-hmm.
Because there's no way somebody can come in and understand the full context of why you do what you do. And if they look at just the numbers, they miss something. They may miss something critical just because the numbers don't look good, but it could be core to, say, supporting another service you provide or something like that.
Okay. Well, thank you all. I appreciate that input.
Yeah. Do you have clients who are doing that, Travis?
No, I have none. The whole concept was kind of introduced to me in the last year. So it's just something that I'm not overly familiar with. So it's just good to ping it off you guys.
Mm-hmm. So, all right. Any other questions? Glad it was timely for you.
Can you have some of your own massive discount creep for me?
We should have another conversation. Yes. Could do that. Let's chit chat again and see if we can work something out with you. So,
yeah.
Yep. Okay. Well, happy Friday to everybody. You get 9 minutes back in your day. Thanks for joining us. We very much appreciate it. If you have any questions, anything that comes up, just let us know. And we hope to see you in August.